to get started.
All right. Thank you, Chrissy. Good morning, everyone. My name is Patricia Pryor. I'm an audit partner, and I primarily work with not-for-profit and higher educational institutions. Today, we're going to be talking about revenue recognition and how those changes are going to impact not-for-profits. Our learning objective today, we're going to cover a couple of things. The first thing we're going to do is we're going to look at a definition of a not-for-profit, when a not-for-profit could be classified as a public business entity, because that could impact the adoption dates for these new standards. We're going to talk a little bit about Topic 606, which is revenue recognition for exchange transactions, and then we're going to get into the new grants and contribution revenue recognition standard, that both of these and how both of these will impact not-for-profits. We will also spend a little bit of time looking at how these will impact your financial statements and the required disclosure. Just as a point, we've had several webinars on Topic 606, so this is not going to be a deep dive. It's just going to be just to walk through a quick refresher. So the first thing we want to deal with is your not-for-profit an accelerated filer? The FASB excludes specifically not-for-profits from the definition of a public business entity. However, the FASB did conclude that if a not-for-profit has access to the public capital markets, including those acting as in a conduit manner, they may be classified as a public business entity and therefore would be subject to different effective dates and additional disclosures as if they were a public entity. So let's talk about what makes a not-for-profit a public business entity. The definition that FASB has issued is that a not-for-profit entity that has issued or is a conduit bond obligor for securities that are traded, listed, or quoted on an exchange or an over-the-counter market will be considered a public business entity. So what is a conduit bond obligor? A conduit bond obligor is an entity that is obligated for the repayment of conduit debt securities. And so what are conduit debt securities? Conduit debt securities are defined as municipal securities that are issued by either a state or local government agency or instrumentality on behalf of a third party, normally a not-for-profit. Typically, you see these as development authorities and so forth. So if you are not-for-profit and you have conduit debt securities, you may be classified as a public business entity. We also need to look at the definition of what it means to be publicly traded. One of the key things here to understand is that if you have conduit debt, it's when looking at whether or not it's publicly traded, it's not just about who may have initially purchased the securities or who is currently holding the securities. It's about who has the ability to purchase the securities. So is it publicly traded? So when we look at the standard, there are a couple of things that we recommend that you do. First thing you need to do is look at any financial instruments that you have and make sure you understand the nature of that instrument. Not all conduit bonds necessarily fit into the characteristics of being publicly traded. So just because you have conduit debt or you have bonds issued like through a development authority does not necessarily mean that you are a public business entity. Doing an evaluation, so you are looking at your financial instrument documents. This is not a one-time event. So the first thing you need to do is look through your current financial instruments. And every time you get involved with a newly issued security, it needs to be reviewed to make sure you are not meeting these rules. One of the things to be aware of, though, is that look for characteristics that may indicate that it may be a private placement. Some private placements, because the release of the securities is limited to a small number of institutions or accredited investors, they may not be considered publicly traded. Also, if you find yourself in a situation that you can't make a call based on what you're reading, always remember to consult with your legal counsel or your bond trustee to get the additional information you need. Now, once you've gone through that assessment, regardless of what conclusion you come to, make sure that you have done a good job of documenting your review of your financial instruments with any supporting documentation that supports your conclusion. So if you are meeting with your auditors or if there's a potential issue, that at least you'll have documented the process you went through and the reason that you formed the decisions you did. One thing, if you're still struggling, I just want to give you the guidance that you can look at. The AICPA actually issued a technical question and answer document that's dated October 2017, and they also did a follow-up article that was issued in December of 2017 that goes through in a lot more detail whether or not a not-for-profit may be considered a public business entity, and it gives specific definitions around what a security is, what does it mean to be publicly traded, to assist not-for-profits in going through this review. And the big thing here is if you are deemed to be a public business entity, then as you will notice, there will be certain standards where the FASB is going to say that if you are a public business entity, this is your adoption date. So you have to be aware of those. And pretty much what it does for a not-for-profit, it moves your adoption dates up usually a year early. So that's something to be mindful. And that this actually does apply for the revenue recognition standard. So it's something you need to make sure that you're doing an assessment of right now. At this point, I'd like to do a poll question and find out, are you is your not-for-profit an accelerated filer? So the choices are yes, no, or I'm not sure. So if everyone could submit your response to the polling question, I'd really appreciate it. And once we're done, I'll share the polling results. Okay, I think we'll go ahead and close the poll and see the results now. All right, so the polling results indicate that 6% of us said yes, we are an accelerated filer. 71% of you are saying no, and 24% are saying I'm not sure. So for those that are saying you're not sure, you may want to start reviewing. And the key there, just so you know, is that if you are a public business entity, and let's say you're a June 30 entity, the revenue recognition standards start for you effective July 1st, 2018. So let's get to that one. All right. Now we're going to go through how we implement the revenue recognition standards and what the process should look like going forward. So it is a new day. For all not-for-profits, the new process is going to involve two key standards. Number one is the Topic 606, which is for exchange transactions, and the second authoritative guidance is going to be Accounting Standards Update 2018-08, which deals with clarifying the scope of accounting for contributions made and received. So these are the two bodies of guidance that you will follow when you look at revenue recognition to deal with when is revenue recognized, what disclosures are required, and what changes need to be made in the various financial statements. So let's take a minute just to kind of walk through at a high level Topic 606 or revenue recognition. Topic 606 applies to all exchange transactions, and this deals with any contract with a customer in which each party receives commensurate value. I want you to pay attention to commensurate value because that, I will define that in a minute, but that is one of the key changes that is happening. Topic 606 does eliminate industry-specific revenue recognition approaches. It does exclude financial instruments, insurance, lease contracts, and guarantees. So those are specifically excluded. So those things don't have to follow Topic 606. Topic 606 provides more of a principle-based approach to revenue recognition, and the intent of the FASB was that 606 would improve comparability of revenue recognition practices between entities and provide more useful information through enhanced disclosure requirements. So that was the intent of Topic 606. And what is the core principle of 606? Basically, it is that you will recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration or the funds given up to which the entity expects to be entitled to in an exchange for those goods or services. So basically you're going to transfer goods and services, you're going to receive compensation for those, and the core principle is that, that is the way revenue will be recognized. Now, what's behind that core principle? It seems very simple, these 5 simple steps when applying the revenue recognition standard, but it is more complicated than it does look. So let's talk about the 5 key steps in 606. The first step is you have to identify the contract. The next thing you have to do is, in that contract, there may be performance obligations. So you have to identify what those performance obligations are. Then you have to determine the transaction price, and then you allocate the price to the performance obligations, and then when those performance obligations have been satisfied, then you recognize revenue. Sounds pretty simple, right? Just want to talk a little bit, though, about some of the key changes within Topic 606. So the first step is you have to identify the contract. So how do you know when a contract exists? There are a few things, 5 key things that the standard highlights that are on your screen. One, the contract has to have commercial substance. There has to be a change of cash flow. There has to be a business reason for it. There's an approval and a commitment of both parties. The contract has to have enforceable rights that can be identified. The terms and the manner of how you will be paid can be identified within that document, and collectability is probable. So those are the key things. One of the things the standard does talk about, though, is doesn't mean it has to be in writing. It doesn't always have to be in writing, but that is the preferred way. But if you have agreements that are not in writing, if these kinds of things are clearly delineated, then you do have a contract. The second item, which is the new term in Topic 606, is performance obligations. What is a performance obligation? A performance obligation is a promise in a contract with the customer to transfer either of these things. So it's a promise to either transfer a good or service that is distinct, or a series of goods or services that are substantially the same and have the same pattern of transfer to the customer. So a performance obligation is, what are you committing to in this contract? What good or services are you going to provide? And those services should be delineated. The transaction price. Many times this is very simple. A lot of contracts will have stipulated amounts in there. What may get tricky, however, is how do you allocate the price if it's not clearly delineated in the contract to each one of the performance obligations. So that is something that will require maybe some assessment if your contracts don't identify specific transaction prices that are aligned with the performance obligations. All right, so Topic 606, when is this effective? Okay, if you are a December 31, 2018 entity, So that means if you're not a public entity, 606 is effective now, January 1st, 2019. However, if you are a not-for-profit that's deemed a public business entity, hopefully you're not a 1231, because it means you should have already adopted Topic 606 for your year ending December 31, 2018. If you are a June 30 public business entity or a not-for-profit that's classified as a public business entity, that means Topic 606 is applicable on July 1st of 2018, which means it's effective now for you. If you are June 30 and you're not a public business entity, it would be for June 30, 2020. All right? So the other standard that is going to impact revenue recognition is Accounting Standard Update 2018-08. This standard applies to all entities, both not-for-profits and business entities, any entity that receives or makes contributions unless otherwise indicated. Just a point, there are several people that are saying that the slides look a little bit different. Yes, I did make some changes, so we will update the new slides later on. All right. So it applies to both contributions that are received by a recipient and contributions that are made by a resource provider. So if you are a not-for-profit that receives or makes contributions, the standard applies to you. One of the things to point out here is that when you look through the guidance, it doesn't matter if you call something a contribution, a grant, a donation, whatever lingo your not-for-profit uses, it does not mean that you get excluded from the standard. All of these types of revenue will fall under ASU 2018-08. So one of the key things here is to not get caught up in whether or not you call it a contribution or grant. The standard still applies. So what is excluded from ASU 2018-08? Any exchange transactions, any transactions where you're acting as an agent, trustee, or intermediary. And normally if you're acting as an agent or a trustee, you're not probably recognized in revenue anyway. So any other tax exemptions, tax abatements, transfers from government entities to business entities, and third-party payers. So those are specifically not scoped into ASU 2018-08. So what does 2018-08 really do? It does clarify that an exchange transaction is a reciprocal transfer in which each party receives and sacrifices approximately commensurate value. And that's one of the keys in this new standard is commensurate value. So what is commensurate value? Commensurate value is a reciprocal flow of benefits that occurs between the parties to the transactions. So think about it. If you're in a transaction, you're either giving up something or you're getting something in return. So you're getting commensurate value. So goods or services that provide a directly benefit the resource provider or are for its own use is considered commensurate value. If the resource provider obtains proprietary rights to things, patents, copyrights, exclusive knowledge, those are considered commensurate value. All right. ASU 2018-08 also updates some definitions that we are all very familiar with. What a conditional promise to give is, donor-imposed condition, and contribution. We're going to take a minute just to walk through what the new definitions are. I'm not going to focus on the old definitions. So conditional promise to give. A promise to give that is subject to a donor-imposed condition. So that is the new definition of what a conditional promise to give is. And then let's look at a donor-imposed condition. And this is one of the ones where you'll see one of the bigger changes. So a donor-imposed condition is now defined as a donor stipulation that represents a barrier that must be overcome before the recipient is entitled to the assets transferred or promised. Failure to overcome that barrier gives the contributor a right of return of the assets if it has transferred, or gives the promisor the right of release from the obligation. So the key thing is there now a donor-imposed condition is defined as there must be a barrier present for there to be a donor-imposed condition. The new definition of a contribution: an unconditional transfer of cash or other assets, as well as unconditional promises to give to an entity or reduction, settlement, or cancellation of its liabilities in a voluntary, the key word there is voluntary, non-reciprocal transfer by another entity acting other than as an owner. So you have a voluntary, non-reciprocal transfer by another entity that is not the owner. So that's the new definition of a contribution. So, I just talked in high level about the standards. So where does this really impact all of us? And the key impact areas for not-for-profits will be in private gifts and grants, government agencies, and other contributions. And why is that? One of the premises that has always been sort of embedded when we think about like government grants and certain types of grants is that, the government does not make a contribution to not-for-profits. So therefore, you could never have a situation where a government agency is making a contribution to a not-for-profit. But one of the things that's embedded in here is that if there's not commensurate value, so if you have a grant and the grant has been received and the government agency or the private foundation that's given the grant is not really receiving anything of value, under this new standard, those government grants and the private gifts and grants will be considered as contributions, which means you follow contribution accounting, which is a little bit different because a lot of times before the standard, grants would normally follow an exchange type of process. So that's the one thing to be cautious about, that the intent of the standard and the byproduct of the standard is that there are quite a few private gifts and grants and governmental agency grants that will now be classified as contributions. So that's something to be mindful of and not exchange transactions. All right, so ASU 2018-08, one of the things the standard does, it does have different effective dates for a resource recipient versus a resource provider. So if you are a grant or you're receiving the grant or contribution, and you don't make contributions to other organizations, you follow the resource recipient one. And so basically, if you are a public not-for-profit, that means ASU 2018-08 became effective for you if you are June 30 on July 1st of 2018, which means it's effective now. If you are not a public business entity and you are 1231, that standard is effective for you on January 1st of 2019, which means it's now. So the only ones that have until June 30, 2019 is if you are not for profit and you are not classified as a public business entity. And if you are a provider, you can see the dates are 1 year out. One of the things that has already come up that people have asked is, what if you are in a situation where you are a resource recipient, so you actually receive contributions and grants, but you also make contributions and grants? You can have a choice to have the two different implementation dates, or you may simply say, I'm going to adopt it for both gifts that I receive and gifts that I make, and I'm going to use the earlier of the dates. So that's one of the things that you should consider for those that are in that unique bucket. So let's begin. So what I sort of did is just kind of laid out what our new revenue recognition standards say. Now, how do we actually do this in practice? And basically, it comes down to what I call my three-step process. So step one, the first step in revenue recognition is to determine whether or not you have an exchange transaction or a non-exchange transaction. So let's talk about that. We just talked really high level about exchange transactions, follow topic 606. So if you could just in your mind kind of visualize, so if you have an exchange transaction, you follow topic 606, and if you have a non-exchange, you follow ASU 2018-08, and those are the two key pieces of guidance. So an exchange transaction is a reciprocal transfer in which each party receives or sacrifices approximate commensurate value. So that's an exchange transaction. So both parties are getting and receiving something of equivalent value. The point in the slide here is I want you all to focus on it. It says, and this is one of the pieces, in the past, if there was a transaction where the public was being benefited, that sometimes got us into exchange transaction accounting. But under the new standard, if the entity that's benefiting is the general public, that is not a consideration, and that does not get you into exchange transaction. It actually gets you into contribution accounting. So that's one of the things to be very mindful of. Okay. So if also one other secondary point, if the resulting value of this transaction is, let's say you're going to accomplish part of your mission, it's positive sentiment, you're doing great things in the community, that value, that inherent accomplishing your mission does not get factored into the equation because that is not considered commensurate value. And think about it is in a way, like if you're giving up a good, or you're going to give a good or a service, you're getting what that value of service is worth, and it's not necessarily fair value. It's whatever the commensurate value is that both parties have determined is the appropriate price to pay. So what are some things that are types of exchange transactions? It could be membership fees, sales of products and services, sponsorships, commissions, special events, potentially naming rights. The one caution I want to say here, though, is just because these typically are exchange transactions, it does not mean that that is always the way it may work out. For example, membership fees. If you charge membership fees and part of those fees are tied to a product or service, then that part of the membership fee would be treated as an exchange transaction. The part that is not tied to providing a good or service would be considered a contribution. For example, let's say you have a membership organization, and as being a member, you get a quarterly magazine. And the cost of that magazine is $25 and your membership fee is $100. You could take the position that the $25 of the $100 that you received is an exchange transaction, because inherent in that membership, you are making a commitment to provide that magazine every quarter, and the cost associated or the value of that is $25. So in that scenario, you would have $25 being an exchange transaction and $75 being your contribution. I think the best way to bring this kind of all home is for us to take a minute and walk through a couple of examples to kind of bring this kind of together. The first example we're going to go through it, and then you can use the question and answer pod to let me know if you think it's an exchange transaction or a contribution. So the first example, Not-for-Profit A is a large research university with a cancer research center. Not-for-Profit A regularly conducts research to discover more effective methods of treating cancer and often receives contributions to support its effort. Not-for-Profit A receives resources from a pharmaceutical entity to finance the cost of a clinical trial of an experimental cancer drug the pharmaceutical entity developed. The pharmaceutical entity specifies the protocol of the testing, including the number of participants to be testing, the dosages to be administered, the frequency, and the nature of any follow-up examinations. The pharmaceutical entity requires a detailed report of all the testing outcomes within 2 months of the test conclusion, And finally, the pharmaceutical entity has the right to the results of the study. So from that example, do we think we have an exchange, or do we have a transaction, or do we have a contribution? And I'll flip it back a little bit. Okay. And yes, you are right. For most of you that are saying it's an exchange, you are correct. It is an exchange, and it's an exchange because the pharmaceutical entity, they're entering into this contract. There are specific protocols that have to be followed. They're setting the guidance and the specific guidance that you have to follow. And at the end of it, the pharmaceutical entity owns the rights to all of the results. So this would be an exchange transaction. All right, let's look at another example. University D applied for, and we're going to use this as our polling question. University D applied for and was awarded a grant from the federal government. University D must follow the rules and regulations established by the OMB of the federal agency and the federal awarding agency. University D is required to incur qualifying expenses to be entitled to the assets. Any unspent money during the grant period is forfeited, and the University D is required to return any advance funding that does not have related qualifying expenses. University D also is required to submit a summary of research findings to the federal government, but University D retains the right to the findings and has permission to publish the findings if desired. Okay? So we're going to do a poll. We're going to open a poll for this question. And I'm going to go back so that you can see it again. So, do we believe this is an exchange transaction, or is this a contribution? Okay, so let's open up the poll. Give some of you all a little bit of time. I think it looks like we're having some problems with the poll. All right. It seems like we're having a problem, Christy, with the polling question.
Yeah, so we closed it, and once you close it, you can't reopen it. So they can, if they missed it, they can put it in the questions pod if they missed it.
Okay. So those, just put it in the question pod. Those of you who know me know I'm technically challenged. So for this second example, this transaction is a contribution. It is not an exchange. And it's not an exchange transaction because commensurate value is not inherent in it. So basically, the granting agency provided the grant. Yes, it did stipulate that you have to follow some federal guidance. Any unspent funds are due back, but there was no commensurate value in this transaction. And I'm going to take a minute and go through this a little bit more here in a second. All right. So step one, we said step one was exchange, determine if you have an exchange or a non-exchange transaction. The second step is this a conditional or an unconditional contribution? So remember, step one, you either decide if it's an exchange, you go topic 606, you don't deal with ASU 2018-08. If your contribution, then you follow 2018-08. And so now we've decided that we have a contribution. So the next step is that contribution conditional or is it unconditional? ASU 2018 opens up some new definitions about conditional and how conditional items are defined. And so in order for a condition to exist, there must be a barrier and there must be a right of return. This is not either or, it is and. You must have a barrier and a right of return. So that is the new step you have to go through for the condition to be present. All right, so you have a condition, so the contributions have certain barriers and a right of return. There's, under the new standard, it does away with the whole concept of likelihood assessments in this process. You're not going to say, okay, there's a barrier, but I think there's a 50% chance or a 95% chance we're going to get to that barrier so I can recognize revenue. There's no likelihood assessments done. As a matter of fact, in the old guidance, there was even a concept of remote. If there was a likelihood was remote that you would meet the criteria, you could go ahead and recognize it. The remote probability assessment has also been removed from the guidance. So in assessing whether or not you have a barrier or right of return, there's no likelihood assessments done. They either exist or they do not. So let's talk about what is a barrier, or when you have indicators of a barrier. The first one is you may have measurable performance-related barriers. And those are typical things like where outcomes are specified, there's specific outputs, there's a level of service. For example, the grant may say that in order for the recipient to receive the funds, they must attain a specific level of service. For example, they must serve 1,000 people. They must provide 500 meals. The recipient activities must achieve a specific output. There are specific outputs listed in this grant or contribution document that says that you must obtain. For example, saying, when the services are performed, we expect to see a 10% drop in dropout rates or a 10% drop in people needing the service. A performance-related barrier could also be if you have matching contributions where a donor is saying, if you raise $1 million, I'll give you $1 million. So that's a barrier. Until you raise the $1 million, you're not entitled to the $1 million from the donor. It could also be tied to specific events. I know this is kind of funny, but let's say a donor said, I'll give the university $1 million if we win a national football championship. Well, until that event actually happens, then you're not entitled to the funds, so that is a performance-related barrier. The other type of barrier that could be present is there could be limited discretion by the recipient on the conduct of a specific activity. So, for example, you have to hire specific individuals as part of the activity. You have to adhere to specific research protocols. And the one that will be present in a lot of our grants is going to be you have to follow specific guidelines about qualifying allowable expenses. So if that's in your grant documentation or your contribution document that you have to follow the guidelines of these specific OMB circulars, it can only be those kinds of qualifying expenses. That is a barrier. So in that case, until that barrier is lifted, you're not entitled to the funds. And actually, just let me step back for a second. This is part of why. Remember, I talked about the impact of ASU 2018-08. The biggest impact is going to be that a lot of grants that we had previously treated as exchange transactions will now be contributions. So what you will see from the guidance is that although this grant may be converted to being classified as contribution, most likely that grant will have a barrier that you have to overcome, which generally gets the accounting to be almost back to the way it used to be under the old exchange rules. So basically, until the barrier is accomplished, then you don't recognize the revenue. So just something to be there. And then the last thing is the stipulations that are related have to be related to the purpose of the agreement. The reason this is in there is the FASB was very cautious about making sure that the guidance was not set in a way that recipients and donors weren't, I'll call it, doing gamesmanship. Basically, if you're going to have a barrier, the barrier has to be tied to the purpose of the agreement. So having random things in an agreement will not affect the accounting. And also, another way to think about this is if there are things in the agreement that are administrative in nature, for example, let's say at the end of the grant period, you have to submit a report that shows what the funds were used on. That's more of an administrative requirement. It's really not a barrier. It's just the donor saying, I want an accounting for how you spent the funds I gave you. So that's not considered a barrier. The other area is there must be a right of return. There are certain things like the specific phrases like right of return. It doesn't have to be specifically present, but it has to be implied in the agreement. And the right of return must be linked to the barrier. So that's another reason why you have to have the barrier and the right of return. And just as a point, one of the things the standard does talk about is that, you can't jump to the conclusion that you have a right of return if the organization that's providing you the funds, if part of their normal process is to always have that line in all of their agreements that you have a right of return, that's really not considered a right of return in the way the guidance is set out. So if it's just something that's par for the course, it's just an administrative requirement, that doesn't necessarily mean you have a right of return. One of the things that the guidance also speaks to is that, if you have agreements or that are ambiguous or not clear, that you have to look at if it appears that the items that are in there seem to feel like they are things that are conditions, then you may lean towards the fact that it's a conditional type of grant or contribution. But if there's nothing in the agreement and it's very loose, then you probably don't have a barrier. Okay? To bring this point kind of home, let's walk through a few examples. Example number 3. So, and what we're going to try to determine here is whether or not this contribution, because remember, because we're following this path, we've already determined it's a contribution and not an exchange transaction. So Foundation A gives not-for-profit D a grant in the amount of $400,000 to provide specific career training to disabled vets. The grant requires not-for-profit D to provide training to at least 8,000 disabled vets during the next fiscal year, about 2,000 each quarter, with specific minimum targets that must be met each quarter. Foundation A specifies a right of release from the obligation in the agreement that it will only give not-for-profit D $100,000 each quarter if not-for-profit D demonstrates that those services have been provided to at least 2,000 disabled vets during the quarter. So, in this example, the foundation is giving money. It's specifying the number of the party that's supposed to benefit, number of vets that are supposed to be served per quarter, and then has there's a provision in the contract that says the foundation or the resource provider can be released if the not-for-profit that's receiving the funds does not serve those disabled vets, 2,000 disabled vets every quarter. So in this scenario, do we think we have a conditional contribution or an unconditional contribution?
Is this one of your polling questions?
No, it's not.
Tricia? Okay.
No, it's not. It's not a polling question. All right. Very good. This is a conditional contribution, and because it specifies, it has specific performance barriers in there. So let's look at another example. And Christy, I'm going to try to make this be the polling question. Okay.
All right, great. After you ask the question, I'll pop it up.
Okay. So in this situation, and I'll wait a minute so people can read it. The not-for-profit E is a public charity that performs research on various diseases and allergies, including gluten-related allergies, as part of its overall mission. It receives a $100,000 grant from a foundation to perform research on gluten-related allergies over the next year. The grant agreement includes a right of return as part of the foundation's standard wording and a requirement that at the end of the grant period, a report must be filed with the foundation that explains how the assets were spent. And I know I kind of gave you the answer to this in my lead up. So do we think we have a conditional contribution or is it conditional, yes or no? So Christy, I'm going to move to the poll question.
Great. The poll's open and ready for everybody.
All right.
And everyone who answered poll 2. Okay.
Sorry.
And if anyone had trouble with the other poll, we have your answers collected in the question pod. And as long as you answer 3 of the 4 polls, you'll earn CPE. So you'll be just fine.
Okay. So Chrissy, let's go ahead and close the poll. All right. And 35% of you all said there was a condition, and 65% no, there was not a condition. And the correct answer is that there's not a condition. That's not a conditional contribution, because the nature of the gift was that it was part of your mission. There was no barriers. There was no specific protocols, and the requirement to submit an administrative report is not considered a barrier. Okay. So step 3. Now we have a contribution. We've determined whether or not it's conditional or unconditional. And the last step is it with or without donor restriction? And hooray, there are no changes to determining whether or not your contribution is with or without donor restriction. So that's the great thing. So that has not changed. All right, topic 606, disclosures. If you've not had the pleasure of reading 606, I encourage everyone to do it. And what you'll see is that topic 606 has a lot of new disclosure requirements. So if you have exchange transactions, you have new disclosure requirements. Some of the key disclosures you're going to have for all your exchange transactions are, you're going to have disclosures around your contracts with customers, performance obligations, contract balances, and disaggregation. So for example, contracts with customers, you're going to have to disclose revenue recognized from contracts with customers versus other revenue sources. If you have impairment losses based on receivables that are tied or contract assets that are tied to those contracts. Performance obligations, a lot of disclosures. You're going to have to disclose significant payment terms, nature of promised goods or services, transaction price allocated to remaining performance obligations. There's a whole host of new disclosures for exchange transactions. Contract balances, you have to disclose opening and closing balances, timing of performance obligations versus when you receive payment. If there have been any significant changes in contract balances are now required, there's some required disclosure. And then finally, disaggregation. You're going to have for exchange transactions, you're going to have to disclose, disaggregate your disclosure by type of good or service. If there are geographic regions that it relates to, or it just slipped me my mind real fast. If there are market or types of customers, types of contracts, whether they're fixed price or time and materials, if you have any contingencies, all of these things are now part of the disclosures under Topic 606. The disclosures for ASU 2018-08. One of the things, if we could step back here, if you remember I said that one of the biggest impact areas here is going to be that a lot of private gifts and grants will now be, and government grants may trigger or fall into contribution accounting. One of the things, though, that is a good thing that comes out of this, though, is that it does not require you to change the titles of things. So, for example, if on your statement of financial position you had contributions receivable and grants receivable, you don't have to go in and change the titles on your financial statements. You don't have to consider and classify on your statement of activities any government grants as contributions. You can continue to classify them as government grants, contributions, whatever you feel is appropriate on your statement of financial position and your statement of activities. So that is not going to change. What is going to change, though, is in your revenue recognition footnotes, you're going to have to clarify for your grants and private grants and government grants that they are contributions and all the other pertinent facts around how you recognize revenue under those the new standard. So that will change. There's also the simultaneous release. And if everybody can remember, embedded in revenue recognition for not-for-profits is a specific allowance that says, if you're a not-for-profit and your policy is that you report donor-restricted contributions when the restrictions are met in the same period as when you recognize the revenue, that you can, instead of running it through without donor restrictions, net assets release, you could generally just put it in your without donor restriction column or your O unrestricted column. You will have that option for under this standard. The only thing is that if you're going to do that, you're going to have to disclose that you're doing that, and you're going to have to use the same, you're going to have to use it for investment gains and income. So you can't have the simultaneous release for some categories of revenue and not for others. And basically, in some of the trainings I've done on this, a lot of not-for-profits are saying, you know what, for my grants and my contributions, I don't think I'm going to use the simultaneous release because they want to show that those conditional contributions of those grants are with restrictions and then flow them through. So that's just something to note that you have to make that decision as to whether or not you want to do that. And if you do, you have to be consistent, and you can't change the accounting from year to year. So that's something to be aware of. The other area where I think initially you may not think this impacts is your contribution receivables footnote. Prior to ASU 2018-08, we know the guidance says if you have long-term receivables related to pledges, contributions, you recognize what's going to be paid over the next 5 years, you show your discount, you show any allowances against those numbers, and that's in a footnote. Well, if you have government grants or private grants that are now triggering contribution accounting, those items will have to be in that footnote. Now, the guidance doesn't say you have to combine it all. Maybe you have two footnotes. That's going to be the call. We're going to be looking at examples of what this may look like coming up very shortly. But just remember that those government grants and those private foundation grants that have typically followed grant accounting that are now contributions, you're going to have to disclose any long-term receivables and related discounts. Also, one other point here, if you are a grant provider, so you're making grants to other organizations, you are also going to have to include that in your footnotes. So if you are a private foundation and you're making grants, you now have to include a table, a footnote that shows the grants that have been committed for the next 5 years. You have to apply a discount. So that's something to be mindful of. That is one of the changes that we need to be aware of. ASU 2018-08 transition. Early adoption of the standard is allowed. You also have the option, if you want to apply this standard retrospectively, you can. But I would caution you on that, because Topic 606 has certain requirements, and under ASU 2018-08, if you want to go back and change things, let's say you're presenting comparative financials, you can if you want to, but that is not required. What is required by the standard is what they call a modified perspective approach, which means that if you have contracts or contributions that are completed, you don't go back and change anything. What really matters is if you have contributions or contracts, gifts and contracts that are in midstream or in the middle of performance. Basically what this guidance says is that you don't go back and change what you reported in the previous year. You just pick it up from the date of the standard becomes effective, and you account for the uncompleted parts of those contracts on a go-forward basis, which I think would be a little bit easier. And part of that is because the intent of the FASB was that there would be no restatements related to and no cumulative effect adjustments related to the adoption of ASU 2018-08. So please look to the guidance and see what works best. But remember, you don't have to do it on a retrospective basis. It is a prospective adoption. Our last polling question is, are you ready for the new revenue recognition standards? Do you feel like you're very ready, you're somewhat ready, or not at all? Chrissy, can you open the poll?
Yeah, poll's open. We've got 97% voted. Okay.
So it seems like 76% of us feel like we are somewhat ready, and an equal percentage feeling that not ready at all or very ready. So that's great. I know there were some questions that came in through the question poll. Chrissy, can you download those questions, and I will send the responses to all the ones that I did not cover in the presentation.
Sounds good.
All right, this concludes our webinar today. If you have any questions at all, please do not hesitate to drop me a line. My email address is on the screen. And thank you so much. And hopefully this was very helpful to those of you who have to deal with this in the very near future.